Hey, hello friends, Martin here from Secret, the channel for learning about trading and investing. Welcome to the weekly stock market analysis where we look at the technical charts and try to understand what happened in the market during the previous week, and then also plan for a better trading week that's starting from tomorrow, November 18th, Monday 2024. So here we go. We had big correction, big crackdowns of 2.56%, that's 600 points gone. Nifty and Banknifty is 1,375 on 2.67 points gone. So the correction Nifty is 10.67, but in Banknifty it remains to be 8.4 itself even now. And but we had a very good rally, and now the correction has breached the 20, 50, 60 exponential moving average on both indices, and that's it. So this is a quick boards view in the weekly and right side daily on the Nifty. So it's showing that it's a panel channel and it has hit the top and then it's correcting since last several weeks now, right? Only 8 weeks or something. And Nifty, you see the head and shoulder breakdown clearly meeting its chart, and 200-day moving average is where the support is there, right? On the Nifty and Banknifty, the narrowing. Banknifty was not correcting much while the Nifty was doing that the previous several weeks, but this week that seems to be changing the story where the consolidation is strong and a deeper correction has taken place with 1,400 points nearly, and the narrowing wedge is almost cracked. So a breach of this trend line of the narrowing ascending wedge would mean that more corrections could come in as low as 46,500 probably, at least. So weekly charts, so right side of the daily chart is also showing a head and shoulder breakdown, and supported the 200 exponential moving average, and the trend line channel, parallel channel, where it was moving around all these weeks and months, it's now also looks like it's getting breached, and 200 exponential moving average is where both indices are there as of now, right? So candlestick wise, if you see, it's a very wide range bearish candle on both indices, left side Nifty, right side Banknifty. And daily charts, if you see, it was a truncated week of 4 days only, 4 trading days only, and you can see that it was complete breakdown or a crackdown that you see on Nifty and the Banknifty also the last 4 days candles, and the final candle is indecisive, so Nifty is correct 11%. It's thinking, should I more correct or not? Banknifty on the other hand is also kind of small body indices, but it's an overhammer. There's a possibility of reversal that could happen, right? If this high of this candle can be clear tomorrow for the next trading day, then we can hope for that. Otherwise, does not have any more meaning for this candlestick last one on the Friday. Other than that, it's just indecisive, just a small body. So the candlesticks and both bands are showing clear expansion on the downside, which means more fundamental fault can be there. Bank just not having that expansion, but that expansion also is not coming. So both the bands on both indices are showing further more downfalls. Candlesticks are bearish, both the bands are bearish, patterns are bearish, supports are all gone. So it's a very bearish scenario as of now, no doubt about that. Let's look at how the momentum and the trend is behaving. So the medium term Nifty and the Banknifty is what you see on the left side. Right side you have the daily. So the momentum indicator is showing sideways falling in case of Nifty and the Banknifty. So medium term momentum is still sideways and falling down towards the BS one, but it's sideways still. But daily charts, that means very short term. The short term charts and the momentum indicators RSI showing that momentum is slipped into the bear zones of RSI below 40. Trend is also showing the ADX is what we use. So trend also is in the bear zones, and that bearishness is increasing on all time frames on both indices. That's the story. So absolute bearish trend with a bearish short-term momentum is what we are seeing. That's a nutshell. We're talking about volatility. Indian weeks is a measure of that, the fear and the greed as well. Nothing much, it is kind of flattish, but 2% spike, and it's still very close to the 15th median range volatility. Volatility has spiked up, but not spiked too much. Neither is it cooling off. Not cooling off means that there is fear in the market. That's what we can assume, but probably is pretty high, not too high. Open interest is a short build up on the Nifty and long unwinding on the Banknifty as per the futures open interest on Friday. Now the Banknifty does not have a weekly expiry next month alone, so it's the monthly expiry charts of the options that is shown. All details also based on the monthly for the Banknifty henceforth. But for the Nifty, weekly expiry is still there, and you're seeing that the open interest is having a PCI which is bearish. The Banknifty is also bearish because it's less than 1, but it's less bearish, you can say. Not bullish enough, you can say that's better. So yeah, that's what open interest is showing on the futures and the options. So options can be used for understanding the levels of the support and the resistance. So as per the latest, it's a truncated week. So whenever it opens, the weekly expiry of Nifty shows 23,500 with the highest put rating seen, and 23,500. Oh, there's something wrong there. Got to check that once again. Sorry about that, but yeah. So resistance 24,000. So it's trouble there. Let me recheck then yeah. So let's really look at the support resistance levels as per the options OI for the Nifty and the Banknifty. Banknifty is monthly, is no longer any weekly. So levels are saying 22,500 and 24,550. That's where the highest support and resistance is there. Highest put and call writing is in there. After 23,000 and 24,000 is for the next highest put and call writing is there. This is for the Thursday's expiry weekly. The Banknifty for a monthly expiry, 46,000 is where the highest put writing is there. 54,000 is where the highest call writing is there. Second highest in put and call writing is there. 49,500 and 52,000. That's a mistake there also. It's not 5,200, 52,000. So now looking at this chart, see there's another way of finding the support and resistances, right? That's using the previous lows, the previous resistances, the Fibonacci, the exponential moving averages. These are all the different gaps. These are all the different ways of finding support resistances technically on the charts, right? With the open interest data or data, we can find support resistances. Likewise, we already seen that, right? Now here we are looking at it. So make a note of these levels and compare that with what the open interest is showing, and then try to reach a conclusion on where the support resistance probability could be. Then you place your bets accordingly. That's the process, right? Nifty, right? So here, we can see that 200 exponential gap is a good support. If that breaches, and Fibonacci 61 is a good support, right? So 23,500, if that is breaching, then it goes down to 23,000, 150 something, and then if that price is goes to target number 23,000, if that price is equal to 23,800, likewise. So we'll look for support value to be 49,780, right? And then if that price Fibonacci will come in picture at 49,300, that's then 49,000, then 48,671. Previous resistance. In worst case scenario, it can go to the 46,950 or 47,000 nearby by the previous lows there. So the resistance major one is 52,800. Before that, you have the gap. 52,000 comes before that. That will be good resistance. So all these moving average resistances coming at 51,400, 51,580, 51,200. All these are resistances of the moving average of 50,2,800. So that also all resistances that are respectively on the upside journey. That major one is a gap at 52,800, right? Rounding numbers. So look at this and then make a conclusion on, right? Here, Demo means exponential moving average, RL means rounding number, PSL means previous swing lows, PR means previous resistance, right? That's right. Now, if you look at the different sectoral indices, you understand that IT is the only sector that's up. That is the only sector that is bullish, but still not fully bullish because in the short term it's still sideways. So even IT is not ready for any long bets. Nothing is ready for long bets because everything is bearish and big fall has happened across the sector. Metal 5.2% down, auto 3.74% down, pharma 3.5% down, FMCG 4.4% down, reality 2% down, everything down, and everything negative. They all have bearishness in the short term, or they have bearishness on both short term and long term. So across sector has got hit at least too much on the short term at least. But IT is holding it up. In the charts, you can, nothing much to explain here. We see that correction has been happening since several weeks on FMCG, sharp, on pharma, down here pharma, auto, down here sharp correction, metals down here. IT is the only sector that's nothing bearish is happening as of now. like it managed to even climb to the bear zone, to the bull zones. Even the reality is also correcting, but it managed to hold the sideways momentum. So what is falling to the bear zones is the FMCG in the medium term. Short term, everything is moving to the bear zones. So that's a story about the sectoral indices, the major ones. So we look at the index heavyweights. That means the heavyweight stocks that contribute maximum to an index number. STF is the big villain there. All the bullishness, all the attempt to move up has gone. It has given up and fallen back to the sideways from the bullish mode. Crossover of their zones has not happened, but getting ready to do that because bullishness is falling further down. But it's still only sideways. Look at Reliance. It has fallen to the bear zones and crossed over heavily into the bear zones from the trend and momentum both. So Reliance has been correcting more than 25%. Can you believe that? ICICI Bank, another very strong stock. This also seems to have slightly slipped in the sideways. Reliance is a culprit that has been falling like hell. It was this early stock holding itself in the medium term bullishness of Nifty and the TCS sideways. Like bank sideways as usual always. LTC has been correcting and FMCG sector as such is also falling. But medium term managed to maintain the sideways mode. So our medium term is sideways, short term it was falling negative most of them. Medium term everything is sideways and Reliance, the only sector that has gone. Medium term was bearish. Right? Because harm is being done by the Reliance fall. So that's the story about index heavyweights. If you look at the broader market indices in the mid cap and small caps, you can see that the correction continues and it has broken the major support zone. It seems like it is a head and shoulder breakdown, then big falls can happen here. So, right, 6,000 points kind of fall can happen if the chart head and shoulder pattern on the weekly charts works out, but momentum is sideways. Yeah, but on time stock rising, same is happening with the small cap. Also, big corrections happened and it has fallen to sideways from after holding it on the bull zones for a very long time. It was a very long rally that the broad indices had seen for the last several years. Now, the correction time. That's what you see. So the correction is not just in the indices, it's across the indices, across the broader markets, across market capitalization, across everything. So, alright, that's what is happening. Now let's pull away from the charts for a while and let's look at what the institutional participation is showing. So it's another 9,680 crores of selling has happened from the price. They had been selling like I don't know whether it just reached the 1.5 lakh crores after adding October and September alone. Probably it might have. But it is continuous relentless selling from the FIs that is pulling down the market like hell. So it's struggling to maintain the buying with every single time that the FIs have been selling for the last September and October. It's October and November, basically. November 15 days and October full month. Days have been relentlessly buying, and it's 12,500 crores of buying that is holding the market. Otherwise, market would have corrected 15% instead of the 10%, just like that in a big. It happened because of the mutual fund money that's coming in. The long-term derivatives also on side has moved down last week. Now we move on to look at the global markets, which is primarily the US markets, and the currencies and the commodities, gold and oil. So beginning with the currencies, it's a 1.6% breakout. Of course, Trump win as the next president of the United States has created some boost for the dollar, and the dollar has moved up 1.64 and seems to be heading up. But still, it's net consolidation stall. But momentum has climbed to the bull zones and USD has weakened like it has broken out of that consolidation and it's 84.4. Can you believe that? It is getting weaker and weaker every day. Now crude oil has fallen and while it's bearish candle, it's quite far from the trend line chart. Good for an emerging country like ours. While the gold is strengthening, the gold is having trouble. It is correcting and the correction is now extended to 4.5% now. All the to the side within the bull zones. It was a very beautiful rally of 28% just in a year, 2024 alone, and now the correction time has come with 4 or 5% correction in just 2 weeks. That's what the hedging instrument gold is talking about. Right. US market seems to be some correction that's coming there also. It hit the all-time high following the US President's election, but it's still in the bullish momentum. All three, that's the Dow Jones, S&P 500, and Nasdaq. All of them are in the bull zones, but this week was red. How red was that? It's 1.25 from Dow Jones, 3.4% down on Nasdaq, and 2.1% on S&P. So red, but still bullish is what US market is all. Just to summarize, US markets have closed red, but not showing much trouble. US momentum is good. Gold is correcting, the US dollar is taking a both is becoming a weak, and crude is in our favor of falling, right? And the next section is about stock picks for the next week. Two short trades. One is SBI Concords. One is to 1.2. 1:2 RiskReward. That's what we are looking for. The reason is momentum slipped. Trend is also slipped. Really bear zones, and it's in a trend line channel, so there is a possibility that it can give you 1:2 RiskReward. Second one is Bajaj Finance. Reason is momentum slipped in the bear zones. Trend also has crossed over the bear zones, and it's a parallel channel. There is a possibility it can move down to the channel low, but I want to do RiskReward. So two stock picks, both on the short side. Bajaj Finance and SBI Cards. Now here is FNO strategy in the options weekly on the Nifty. So we are having bull call spread, bear call spread, sorry. Basically we are bearish. We want to call ourselves the market collects more. So we are selling near the ATM call options and then covering that by buying a hedge at for ATM call. That's what it is. It's completely hedged. You know what we'll risk. And the risk is not that favor if you hold on to the end. You will come out with a 1% kind of scenario. If you get the 1%, and investment is very less because margin current less profit is good, but not that great. And that is the best that you can do when the market is cracking down one side. Or else you have to go for naked selling or buying on one side, downside, put side. But instead of buying that, this gives you less profit, but you are completely covered even if market reverses, right? Or even if, right? So that's just all. Let's see. Bear call spread strategy of the weekly FNO for the next week, and let's wrap it up now. Market has cracked down further. There's a continuation of the correction extended to nearly 11%, 10.6% in the case of Nifty primarily. And it also has corrected 8.4%, and then it's geared up that consolidation, and then that also cracked down from there, and the fact is continuously selling. Keep that in mind, we're having a very long bullish rally since July of 2022. So this is not a major correction, but decent correction has happened. In favor of the bulls, if you try to bucket over the different parameters, and we can come to a conclusion as to what's happening, right? So domestic institutional money is flowing is the only positive thing about for the bulls, right? And the US indices are red, but not for too much far away from the 80 all-time highs. So with the bearish bucket, we have a lot of things in favor of them. Candlestick first of all, bearish. Lower high patterns, bearish. Bearish momentum, bearish trend. Both indices bearish. Bearish build up on the futures high, bearish PCR put call ratio. FI is heavy selling, 1 lakh crore plus. Only bands downside expansion, bearish biased. 20, 50, 100, all expansion going on reserve bond. Index is spiking and near to 15. Not that great. So it's still there. Bottom markets are correcting. All sectoral indices are having corrections, and then no short-term bearishness. And all heavyweight stocks also having trouble. So everything is in favor of the others, and therefore we have to refrain from taking long positions, exercise caution. Middle East crisis and new tariffs in the US and all this are worry that is reflecting the volatility. So view as per the chart is very clear. It's very easy to say it's medium bearish biased, right? So always keep that in mind when there is a big black trend that happens either side, up or down. All the technical analysis, most of the time gets screwed up, and then it's a very short term that you're predicting, so it gets screwed up. So that's quite natural, but black trend doesn't happen very often. Keep that in mind. Technical analysis is just probabilities. Imagine if you don't even have a probability, how will you do it, right? So that's the thing. Now 22,800 and 24,500 is where the levels are there for the next week. What I look forward in the Nifty, and 47,800 to 5500 is what I look for in Banknifty. Now for this rally to continue, we need to climb about 26,000 and 54,000 bottom lines. Otherwise, we are either correcting and remain bearish, or we are consolidating, either of that. Right? So always use your hedge. Don't do it without hedge the positions, hedge your portfolios, hedge everything, because you only have the capital that can be protected. So maximize, and things can go out of the market and give you surprises, then they can happen in the market. Okay. That's what I have. I'm also active in Twitter if you want to subscribe to that, and if you find this useful content, then subscribe, like if you like it, and then comment and share it with others. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.